Let's embark today on a journey to figure out how dangerous is investing of the money or to invest in general. So let's kick off. So how dangerous is investing? What is ahead of us? At first, what can we imagine under term dangerous? How to define it? What does it mean if something is dangerous? Then how can we express amount of danger? Then we will open time window into history and try to see what happened in the past. And then we will try to somehow connect the dots and explain what does it all mean or what is potential meaning of this video. So what can we imagine under dangerous? When we invest, we can lose money. Quite interesting is, if we lose 50% of invested money, then we have to earn 100% to just get back. One example, if we invest 1000, we lose 500, then on remaining 500, we have to make 100% gain to get back into our 1000. So this is why it's super important, if possible, to avoid losses or money lost at the beginning of our investing, because we know what compound interest can do, but this assumes that we have big enough capital. So we should try to avoid as much as possible losing a huge amount of money at the beginning. Then investing can also lock our money and we won't be able to use them. If we invest into something which is illiquid, or if it's traded just, for example, 4 times per year, then we may find ourselves in a situation that we want to withdraw it, but we are not able to withdraw it, or we are able to withdraw it, but with a huge fine. So always also think about this aspect when investing money. And of course, if we want to invest in a way that we are going to analyze the companies, or we want to do day trading, then investing can cost a lot of time, learning, and also money, because usually the valuable information are not shared for free. But we will see during our video that there are other ways how we can invest without investing super huge amount of time. And how can we express danger? Danger, or we can say risk, can be expressed as a standard deviation from mean. So we have some mean gain, usually expressed in a percentage, and then standard deviation would be telling us where on continuum around the mean the real value can be. We can also use term volatility, which means how the investment will go up and down. But we can also express danger as probability of money lost. So we can assume if we invest into this company, there is a, let's say, 70% risk we will lose all the money, but if the 30% will work, we will get 3 times the invested amount. So if we are able to assess it on this level of likelihood, then we can simply multiply the expected gain and expected loss against the likelihood, and then based on the result we can decide. But we can also say that in such case inflation is depreciating our money with 100% likelihood, because if we just let the money be or if we just put them into standard current account without any interest, then just by doing nothing, the inflation will piece by piece eat our money, which is something that we already know from the previous videos about the time value of the money and also inflation. And we can also express danger as ability to select the best possible investment, because usually when we select from, for example, the most common things like stocks or bonds, then there is a huge amount of different flavors of stock and bonds. So how can we know which one to select if there is so much, and which one is the best? So that's also one of the possible dangers of investing. And now let's open the time window into history and let's see what happened in the history, and hope it will be a little reassuring and calming. So we will use for our peak the stocks and bonds, and then gross domestic product, also known as GDP, which is like measuring the power or output of the economy. And of course we will be doing that on the US economy, which is the most advanced economy in the world. So during the last 100 years in US economy were these changes. So GDP rose from 100 billion onto 22 trillion. Then money supply M2, there are like 3 flavors, M1, M2, M3, and the difference in between these money supplies is how much things we put into the money supply. In case of M1 it can be, for example, just cash. With M2 it can be cash and short-term deposits inside the banks and so on. So this money supply went from 50 billion onto 15 trillion. And then stock market capitalization rose from 30 billion to 32 trillion. Now, here is actually something interesting, and that's the GDP is smaller than stock market capitalization. Stock market capitalization is the price of the stocks multiplied by the number or amount of them. And that's because the stock market is trying to appreciate the future. So it's future-looking device. And what we can rely on, the mankind in general wants to grow to have better tomorrows. Because we humans are changing pretty slowly compared to, for example, technology. So that's like some constant inside the changing times. And because we want to have better tomorrows, we want to be better, then work effectivity grows, amount of value grows, and so the size of the economy grows. And together with the size of economy, obviously, everything else grows also. Now let's check what are the average stock market crises by history since 1835. Again, we will be using US stock market, so the average decline has been 37%. So 37% from the max when there was a stock market crisis, and this decline lasted 26 months. A recovery to previous highs occurred on average within 5 years. So nearly 2 years it was dropping, and in average it dropped 37%, and then it took 5 years to go back to previous maximas. Now, how long do recession periods and economic expansions last on average? So, little positive is that recession usually lasts only about 14 months, and then expansions last around 47 months. And if expansions last longer than recessions, then usually we just end higher than previously. And obviously, due to the human nature, and downturn is always followed sooner or later by growth. and the latter is more pronounced after a downturn. So if there is like a lot of bad mood, a lot of pessimism, and suddenly the situation improves itself, then obviously the growth at the beginning is huge because there is like euphoria, happiness. So the growth is pretty fast right after the downturn. Now, how about the riskiness of stocks and bonds on a long time horizon? Again, we are using US stock market. So if we take 20-year horizon, the standard deviation, which represents the volatility for stocks, is 3.4% and 3.2% for bonds. So you see that over 20 years, there is not so huge difference in between volatility or riskiness in between stocks and bonds. And on 30-year horizon, the standard deviation for stocks is 1.4 and 2.8 for bonds. Now, how is this possible? That's possible because stocks represent like a right on an earning of the company, which means they are able on long term to surpass the inflation, because together with inflation the prices grow, and with prices growth the companies can make more money. And then because owning the stocks is like owning part of the company, then you also own part of this higher earnings, and so that's the reason why on so long period the deviation of stocks is smaller. And on 30 years the average appreciation was 11.2% for stocks and 5.3% for bonds. This is not inflation corrected, so this is just nominal expression of the interest rate. If you want the real expression, it would be necessary to correct it by the inflation, which means subtract the inflation percentage from these interest rates. And now let's try to do something else. Based on historical data, there has been appreciation since the 17-year holding period for stocks and bonds. So what was like the different or possible outcome if we held 17 years stocks or bonds? So for stocks, the inflation corrected gain was ranging in between 0 to plus 15% per year. And here, because it's adjusted for inflation, the 0 means that the money just kept the value, so they were growing with the inflation rate. So it doesn't mean like you did not gain anything, it simply kept its value, which is pretty good. And it's just 17 years. On the other hand, for bonds, the range was in between -3 to +8, adjusted for inflation. So from this point of view, what is more dangerous? To long-term hold bonds or stocks or equities? Obviously, at least based on this data and these results, in this case would be better to hold stocks. Much of the wealth of US stock market was generated by just 4% of stocks. Now if we imagine that inside US stock market throughout the history there was like 26,000 stocks, so it's clear that for us human it would be invisible to analyze every single one of them. But only 4% of these helped for the majority of growth of stock market. So this means if we do stock picking, it's quite easy to miss the mark when picking individual stocks. So if we do not want to invest a lot of time into studies, learning, and analyzing the individual stocks, then it's simply easier to buy ideally full market or, for example, S&P 500, because in such case, together with all other stocks, we can be quite sure that we will hit also some of these 4% of stocks which were responsible for the majority of growth. And now let's see what was the annual return on other common investments in between 1940 to 2018, again done on US stock market, and it's not inflation adjusted. So for stocks it was 11.1%, for gold it was 4.7%, real estate in total it was nearly 10%, there was 4.8% price appreciation and 5% rental gains. Then bonds did 3.2% and treasury bills, which are like short-term bonds, they did 1.7%. Now, what does it all mean? It means, in general, because the humans did not change so much, that humanity wants to do better, and therefore, at least so far in the history, every downturn will eventually be replaced by growth. We know from history that average downturn lasts 17 months, but the average upswing 47 months. We also know from history that stock market declines on average 37%, and this decline usually happens within 26 months. And then in another 5 years, in average, we should be back on the previous maximas. And then we also know from history that 4% of stocks have been responsible for almost all the growth. So if we want to do stock picking, we should really invest a lot of time and money into getting all the required knowledge. Otherwise, we are at the risk of missing these 4% of stocks. So for the majority of us, the easiest and the simplest solution would be to try to buy the full market. Because if we do nothing, then with 100% likelihood or probability, the inflation will eat our money. Now, obviously, the history may not repeat itself in exactly the same way, but so far, it has always been true that humanity wants to develop and grow. And because of this, GDP continues to grow. And together with GDP, also the things like stocks, bonds, houses, simply rare things also continue to grow. Since there is a time value of money and inflation, without investing, more precisely buying assets, the value of our wealth will get smaller and smaller. So if we would be just holding money or spending everything on consumables, then we may find ourselves getting worse and worse. So in the short term, stocks are definitely riskier than holding bonds. However, even with a 17-year holding period, the stocks outperformed the bonds, and it was done inside the US. Now, which is logical because a stock is a share of firm's profits, and as the economy grows, so do the firm profits. But in case of bonds, it's just borrowed money. So if investing, but now here speaking about the passive one, which means in case of passive one, we just buy, for example, some ETF on S&P 500 or ETF, which is trying to combine the stocks from the full market, is easy. Why isn't anyone talking about it? That's simple. Because for us to know about something, someone has to pay advertisement. And for investment companies, they make money when we trade. So for them, it's beneficial if we trade. So that's why they are not trying to point us in a direction of passive investing. And of course, if you are amazing active investor, you can make a lot of money. But as we know, it's just sufficient to lose 50% at the beginning, and we may never be able to recover from it. So for the majority of us, the passive investing, it's just the way to go. And then obviously if person believes something is easy and can do it on his own, he won't pay for it. So if some fund would be buying just ETF fund, but the fund will charge us 2%, and then the fund will buy ETF which is charging just 0.1%, so the fund would be making out of us 1.9. And obviously if we realize we can do exactly the same, then we won't pay the fund, but we will go and buy ETF fund ourselves. And that's it. So no one wants this to happen because it would mean cut of the earnings. So it's up to us to think for ourselves and do what is best for us. And of course, investing in most cases increases wealth slowly. So if you want more money, you need to solve other people's problems and thus bring value to them. Of course, there are exceptions that by accident you invested into something which tripled or maybe increased the value 100 times and now you are super wealthy. But these are rare cases. For majority of us humans, the wealth building is slow process. So if we want to make a lot of money, it's much easier to bring value to other people. And this is how the wealth is built. And what about you? How do you plan to invest your money?